Good afternoon, everyone, and welcome to the bank's Inflation Report press conference. On my left is Dave Ramsden, the Deputy Governor for Markets and Banking. On my far right, Ben Broadbent, the Deputy Governor for Monetary Policy. And on my immediate right is the Governor, Mark Carney.
Thank you, Gareth. Good afternoon, everyone. A series of transitions are underway that will affect the outlook for the UK economy and the stance of monetary policy. First, global financial conditions have begun to tighten and trade growth is slowing. As a consequence, while the global economy continues to grow at above potential rates, growth is becoming more uneven and is expected to decelerate towards its potential rate over the course of the next few years. Second, UK fiscal policy is shifting from a restrictive to a more accommodative stance. Third, and most importantly, the UK economy is in the process of adjusting to a new and as yet uncertain economic relationship with the European Union. As has been the case since the referendum, the MPC's forecasts are conditioned on the assumption of a smooth transition to the average of a range of potential Brexit outcomes. As the deadline for concluding the withdrawal agreement approaches, the expectations of households and businesses are diverging somewhat from this base case assumption. In general, households are more sanguine, while businesses are more wary. These shifting expectations could lead to some greater than usual short-term volatility in the data. Momentum in household consumption appear to be greater than previously thought. UK households remain resilient to a Brexit that has not happened. Consumer spending is being supported by a tight labour market, with the employment rate and vacancies at record highs, and the unemployment rate close to record lows. Regular pay growth has been stronger than the MPC had expected, rising to over 3%. In contrast, business investment has been weaker than previously anticipated. The level of investment fell by more than 1% in the first half of this year and is now almost 15% lower than the MPC had projected just prior to the vote. As the Brexit deadline looms, UK companies are now understandably postponing investment until they have greater clarity over the UK's future trading relationship with the EU. Financial markets are hedging their bets against Brexit downsides, with sterling risk reversals building despite sterling already being some 15% below its pre-referendum peak. In the committee's central projections, GDP growth averages 1.75% over the forecast period. Consumption grows modestly relative to historical rates, rising broadly in line with the subdued pace of real income growth. Growth in business investment is expected to stay subdued in the near term before rebounding as the current Brexit-related uncertainties wane. Net trade is also expected to contribute positively to growth, supported by solid global growth, the lower level of sterling, and the assumed significant access to EU markets over the course of the next few years. The MPC's projections were finalized prior to the budget being announced, and the committee will assess the implications of those budget measures at its next meeting. Although modest by historical standards, the projected pace of UK GDP growth is slightly faster than the diminished rate of supply growth, which averages in our projection at around 1.5% per year. The MPC judges that demand and supply are currently broadly in balance. As a consequence, over the forecast, a margin of excess demand emerges as demand growth exceeds potential supply growth. That supports a further firming of domestic inflationary pressures. For example, whole economy regular pay growth has risen from around 1.75% per year on average between 2010 and 2015 to 2.5% in 2016 and up to 3.1% in the third quarter of this year. With productivity growth remaining below rates typically seen before the crisis, pay growth doesn't need to be as high as its pre-crisis average for unit labor costs to be consistent with meeting the inflation target. Inflation is currently above the MPC's 2% target, boosted by the effects of higher energy costs and the rise in import prices associated with sterling's past depreciation. The contribution from these external factors is projected to fade over the forecast period. So taking waxing domestic and waning external influences on inflation together, CPI inflation is projected to remain above target for most of the forecast period before reaching 2% by the end of the year. At its meeting yesterday, the MPC judged that the current stance of monetary policy remains appropriate. The committee also judges that were the economy to continue to develop broadly in line with the November inflation report projections, an ongoing tightening of monetary policy over the forecast period would be necessary to return inflation sustainably to the 2% target at a conventional horizon. Any future increases in bank rate are likely to be at a gradual pace and to a limited extent. The economic outlook depends significantly on the nature of EU withdrawal, in particular, the form of new trading arrangements between the EU and the UK, whether the transition to them is abrupt or smooth, and how households, businesses, and financial markets respond. Whatever happens, monetary policy will act to ensure price stability and, subject to that, support the economy during the transition. As the MPC has repeatedly stressed, the implications of Brexit for the appropriate path of monetary policy will depend on the balance of its effects on demand, supply, and the exchange rate. So turning to each of those, first with demand. Withdrawal from the EU will affect the demand for goods and services produced in the UK because of changes to the ease with which UK companies can trade with the EU, levels of uncertainty about the future relationship, and earnings prospects, as well as financial conditions. These effects over the MPC's policy horizon are likely to be more negative the greater the disruption to the economic relationship between the EU and the UK, and they're likely to be more positive if there is less disruption. The extent to which changes in demand affect inflationary pressures will depend on how the supply capacity of the economy evolves. As trading relationships change, reductions in openness are likely to reduce the economy's productive capacity for a period of time. Shifts in production across sectors will neither be seamless nor costless, as resources in different sectors, including labor, are often highly specialized. This will drag on supply as the adjustment process unfolds. As changes in supply are usually gradual, they normally have less bearing on monetary policy in the short term than do changes in demand. If the future economic relationship between the UK and the EU changes only gradually, supply losses would emerge relatively slowly. In some Brexit scenarios, however, it's possible that the UK's supply capacity could fall sharply. For example, an abrupt and disorderly withdrawal could result in delays at borders, disruptions to supply chains, and more rapid and costly shifts in patterns of production, severely impairing the productive capacity of some UK businesses. The prospects for inflation will also depend on how the exchange rate reacts and on any tariffs that result from the new trading arrangements. In the case of a smooth transition to a relationship judged to have a relatively small long-term economic impact, financial market participants might expect a smaller hit to UK real incomes than they currently have anticipated, causing the pound to appreciate. In contrast, a disruptive withdrawal from the EU could result in a more pessimistic view of future income and some further depreciation. Turning to the implications for monetary policy, since the nature of EU withdrawal is not known at present, and its impact on the balance of supply, demand, and the exchange rate cannot be determined in advance, the monetary policy response won't be automatic and could be in either direction. In the case of a smooth transition to a relatively close economic relationship, the extent to which domestic inflationary pressures increase would depend on the balance of an expected rebound in demand as uncertainty fades, and any further impacts on supply over the MPC's policy horizon, as well as the scale of the likely appreciation in sterling. In contrast, a disruptive withdrawal from the EU would probably result in a further decline in the exchange rate and a large immediate reaction in supply. Tariffs might also be extended, and each of these developments would increase inflation. Set against that, it's likely that demand would weaken as a consequence of lost trade access, heightened uncertainty, and tighter financial conditions. And the overall extent of inflationary pressures would depend on the balance of these forces, as well as the evolution of inflation expectations. And there are three other important considerations for the conduct of monetary policy. First, the current situation differs materially from that on the eve of the referendum. The economy is now broadly in balance rather than being in material excess supply as it was then. Inflation is now notably above target, not significantly below. And if Brexit is disorderly, any disruption to supply will be immediate and material rather than distant and speculative. Second, there's little that monetary policy can do to offset large negative supply shocks, which occur relatively rarely in advanced economies. And third, in exceptional circumstances, the MPC's remit allows the committee to extend the horizon over which it returns inflation to target in support of its objectives for growth and employment. Given the economy's starting position, this flexibility would only become relevant if the shock to demand were greater than that to supply. In that event, the committee would explain clearly its approach to managing any trade-off between inflation and output variability, including the horizon over which it sought to return inflation to target. However, the Brexit process unfolds, monetary policy will remain guided by the constancy of the inflation target. The MPC will respond to any material change in the outlook, adjusting policy in either direction as required to bring inflation sustainably back to the 2% target, while supporting jobs and activity during this most important transition for the people of the United Kingdom. And with that, Ben, Dave, and I would be pleased to take your questions.
Okay, as always, if you could give your name and the organisation you represent, and please stick to one question for the first go-round at least. So Ed and then Chris to begin with.
Thanks. Ed Conway from Sky News. Governor, in your last comments just then, talking about the reaction function if there is indeed a no-deal Brexit, can we just be clear? Are you saying that if there were to be a no-deal Brexit and if, as many economists think, there could be a recession, even then you can't rule out raising interest rates?
From the committee's perspective, first let's be clear that a no-deal, no-transition Brexit is not the most likely scenario. So we're talking about a less likely scenario, tail scenario. Now we have to be prepared for that, and the committee has given the guidance it has to provide some context to that. Second point is, as the committee has emphasized, it matters what happens to all three factors, the main factors: the exchange rate, what happens to demand, and what happens to supply. Thirdly, what is unusual about that situation, if it were to come to pass, and it's not the most likely thing, but if it were to come to pass, is that there would be a hit to supply, potentially fairly large, and certainly more rapid than one is accustomed to in an advanced economy. And the consequence of that, the committee would need to balance the inflationary consequences of that, the potential inflationary consequences of movements in the exchange rate, and potentially tariffs. Obviously, tariffs is a discrete decision for the government, and weigh that against an obvious desire to provide what support we could to the economy, to jobs and activity in the economy. So there are scenarios where policy would need to be tightened in the event of a no deal, no transition, so-called disorderly Brexit. But I would stress that that is, is not the view of the committee, that is the most likely scenario.
Isn't that just project fear? I mean, that will be the response a lot of people might say.
No, look, we have, the MPC has a clear remit. The remit is price stability, subject to achieving price stability, to supporting the government's economic policy, supporting jobs and growth, if I were to simplify it to that. It will be important that we take our responsibilities. We have some flexibility under our remit in terms of the horizon over which to return inflation to target. We have some ability to look through one-time effects, such potentially as tariffs, distinct from those broader forces. But I think what needs to be recognized, what the committee thinks needs to be recognized, is a couple of things. One, this would be an extremely unusual set of circumstances, an impact on supply, something that's immediate and material, not, as I said in my remarks, something that's distant and speculative, that would have inflationary consequences, and we would have to balance our responsibilities. As we've said in the report, as we've said in the minutes, as I said in my opening remarks, this isn't pre-wired. There's no automatic response. You can't. We will have to look at the situation. If it were to come to pass, we don't think it's the likely situation to come to pass, but we'll be guided in as we always should be by our remit in taking those responsibilities.
Okay, Chris.
Chris Giles from the Financial Times. Just to follow on from Ed's question, in that scenario of a disorderly exit, where you had to balance considerations of demand and supply, how on earth would you know what was the demand effect and the supply effect? Because all you'd see is people hurting, people not being able to buy stuff in shops potentially, and queues on the roads. It's not. You wouldn't be able to know in real time how to distinguish the two.
Yeah. So there's a question. There would be a question again in this less likely scenario, and I hope we'll spend a substantial proportion of this press conference on the more likely scenario, because it's more likely what your viewers and readers are going to be facing. But in this less likely scenario, there would be a need to distinguish between shorter term effects on supply that were caused by logistical challenges, very short and sharp transition challenges, such as you referenced, versus more structural effects on the supply capacity of the economy, which would be the product, as you would recognize, of losing access or losing substantial access to one market, and the economy not yet having had time to reorient itself either to domestic production or production for third country markets. Now, we're not totally uninformed on this, in that these are the types of issues we've been thinking about since the referendum. It's part of the reason why we have an agents network. We look at there are a variety of ways of looking at this, but it will be a challenge without question, and part of the series of judgments we will have to make are exactly around what you're pointing to, Chris, which is what's temporary, what's more persistent, and then the relative balance of that versus what would be expected for other related reasons, a hit to demand.
Okay, Jemana, and then Joel.
Jemana Bersachi from CNBC. To pick up on the more likely outcome, to use your phrasing, assuming we do get an EU withdrawal deal agreed, and we do transition to an implementation period until the end of 2020, you've cited that we may see a rebound in demand if that transition deal is agreed. You've also said we could see upsides on the wage growth front. We've also said that we could see firming domestic inflationary pressures. And then finally, we haven't actually incorporated any of the latest autumn budget spending plans into any of your forecasts. So my question to you is, how much of a tailwind to the economy and to your GDP forecast would all of those issues combined together pose? And do you think it's time to start preparing the market for more than one rate hike a year over your forecast horizon?
So in the event of a deal, as you can appreciate, and others can appreciate, it depends on what the deal is, and we have a conditioning assumption which is an average of a range of outcomes, and so we and others would have to look at not just having a transition period, but what the economy is transitioning to. We do expect a rebound in demand. I mean, emphasize a couple things. One is that one of the things we're seeing in the very short term, we're seeing it in virtually all the surveys. I can even reference something which came out after we finalized the forecast, which is the PMI, manufacturing PMI this morning. We see it in our agent conversations, our agent surveys, which is embedded in here. We hear it in conversation with businesses up and down the country, is that businesses is taking a very cautious approach right now, because we're at the point of if not maximum uncertainty, close to maximum uncertainty, and there's not that much time left until there will be clarity. So waiting a bit of time is understandable. Because we see all that, we have some sense of what's being held back and what would be potentially unleashed with clarity about implementation period and a deal. And so you do see, if you would have seen in the forecast, that we do see a rebound, a notable rebound in investment, and I would recall that investment has fallen over the course of the last year. Investment growth, I should say, has fallen over the course of the last year, and we see a fair pickup in the pace of investment growth over the forecast. Level of investment ends at some 14% higher by the end of the forecast, for example. So we would see that pick up. The way I would, and you're right in noting, and others may ask, but I will do it here on the fiscal. We haven't incorporated the budget into the forecast. The budget came, literally a few days ago. After we closed our forecast, we'll have time to incorporate that, and we'll speak to it at our next meeting in December. But I'll just close with on the last bit of your question. The forecast is conditioned on an average market curve, a 15-day average. We closed that average a week ago, so it was a curve that was higher than the curve at present, something with roughly a bit less than 3, 1 rate increase a year or 3 over the forecast horizon. And that curve leaves inflation a little above target at year 2, which is normally how we would think about the policy horizon, so one can draw conclusions from that.
Okay, Joel, just a couple along.
Joel Hills from ITV News. This week, Governor, viewers will have seen the Chancellor deliver his budget. Households and businesses have been told this week that austerity is over. Are you clear that in the event of an abrupt departure in a disorderly way from the European Union, that austerity will return?
Well, fiscal decisions, Joel, are for the Chancellor and for the government, not the Bank of England. Whatever decisions they take now or in the future, we then take those as given, and we set monetary policy around them. So we can move monetary policy much more quickly than fiscal policy can be moved, and we stay in our lane. We focus on our direct responsibilities, which are on the monetary side. With respect to this week's budget, as I said in my opening comments, there has been a shift in the stance from more restrictive to more accommodative. It's the judgment of the committee is it has the potential to be significant, but what we for the outlook. But we need to do a proper analysis of it and assess how significant from our perspective that would be.
Okay, Andy in the middle, and then Larry behind.
Thank you. Andy Verity, BBC News. Governor, you've referred to, in the event of a disruptive withdrawal from the EU, that there will be an immediate and material hit to supply. Can you spell out in non-economist language what that might mean? Shortages? Price hikes? What do you mean?
Yeah, I mean, Andy, I think we're all aware that in the event of a no deal, no transition Brexit, which is not the most likely scenario, but if that were to come to pass, there will be, at a minimum, there will be, and this is acknowledged by the government, it's acknowledged by the logistics industry, it's acknowledged by the EU, and it would also affect the EU as well. There'll be a series of logistical challenges in terms of getting goods through the ports, and the knock-on effects of those to the ability of businesses, a number of businesses, not all businesses, but a number of businesses, to produce at full capacity exist, and you know, one can make estimates of that.
What will that mean for ordinary people? What will they see?
Well, look, it's to draw it out to the shop or to the or the shop floor. It will depend on the degree to which an individual business is able to prepare for that. So it will be different for different individuals in terms of their jobs, and for us as a whole, and for whatever product or service we're using that hitherto had relied on seamless access to the European market. So in some cases, goods and services will be affected. In others, they won't. And I would stress that in many respects, there are certain, I would distinguish, we would distinguish between issues which are short-term in nature, which is, in other words, the system becoming used to new restrictions, the ability of both sides to increase customs capacity and make adjustments to logistics. I would distinguish between those and more structural issues, which mean that having less access to Europe or more costly access to European markets will mean for businesses either which use parts that come from Europe or which sell their end product into Europe, that they will take decisions to reorient their production to either the UK market or to other global markets. And that will take a period of time.
Forgive me,
Larry,
though.
sorry, we'll move. You may get a chance, Andy. I need to give enough people a chance to have a question. So, Larry, just behind you there.
Okay.
Larry Elliott of The Guardian. You say that the chances of a no-deal Brexit are not that likely, but do you think they're more likely than they were the last time we had a press conference with you 3 months ago?
Well, tough to say, and not probably that productive to speculate on the relative probabilities. I think that, you know, as we get closer to the deadlines, the negotiating deadlines, it concentrates the mind, and it concentrates the minds of a number of businesses that, given that there is still uncertainty, they're taking decisions or not. You know, it's a decision not to invest is a decision as well as a decision to invest. So they're taking decisions to keep things to the side. Not all businesses, but you know, a number of businesses are holding off for the moment until there's greater clarity. And they expect greater clarity, and they will get greater clarity. So that's why there is, in the most likely scenario, pent-up investment demand that one would expect. Certainly, we would expect to see unleashed. Really direct commentary about the relative probabilities or the shape of a potential deal or including a transition are for the government that is negotiating this.
Okay, can we go back over to the right? Ben and then Phil at the front here.
Ben Chief from The Independent. Governor, there's a group of pro-Brexit economists who say that no deal is nothing to fear. What you've laid out today suggests the very opposite. There might be some people out there wondering why they should listen to you and the Bank of England rather than that other group. So what's your views on that? Is it a better forecasting record? Is it better models? What are your thoughts?
Well, look, we're doing our job for a purpose, which is to keep inflation low, stable, and predictable, and to the extent we do that, subject to doing that, to support the economy. We had a set of expectations, for example, prior to the referendum, which that we expected that, and we were on record in this room saying that we expected that the exchange rate would fall sharply, that inflation would rise, and the growth would slow. And part of the reason why growth would slow is the real incomes would be squeezed. And that's, you know, that's what happened. There were others who had expectations that the economy would accelerate following the referendum. What we're basing our views on are a series of things, but it's grounded in it's grounded not just in macro models, but in extensive consultations and regular consultations with businesses up and down the country. We have to supplement our usual agency network, which covers all regions and all home nations of the United Kingdom. To supplement that, we have put in place and have been using over the course of the last 18 months a decision maker panel, which numbers over 5,000 businesses now, and gives a pretty clear view of the scale of reduction in investment growth, so the holding off of investment, and the reasons for that, and you supplement input-output analysis, big picture macro modeling with that kind of grounds-up data. It gives a sense of it certainly gives a sense of the direction of that the economy would head in. It's difficult to estimate the precise magnitudes and the precise timing, and we would draw on all those resources in the event of in the unlikely event that this were to come to pass, in order to make the kind of judgments that Chris Giles was asking about a moment ago.
Phil Aldrich at the Times. There are reports this morning, this is on Brexit, there are reports this morning that there's been a financial services deal on Brexit could be imminent. I was just wondering if you felt confident that this will ensure that the bank does not become a rule taker from Brussels, and if there is a financial services deal imminent, do you hope that there are particular areas where you hope to diverge from Europe in future?
So I saw the reports. It's not for us to comment on them. In that, as you know, we're not part of the negotiations. It's solely the responsibility, as it should be, of the government. From time to time, we provide them with some technical background advice, but we're not any part of the negotiations, nor will we be. I note that the government has not recognized, if you will, the report, words to that effect from DexEU, and stressed, as one would expect in a negotiation as large and as complex as this, that I think the quote is, "Nothing is agreed till everything's agreed," or words to that effect, and similar comments were made by Commissioner Barnier. So with that context, Phil, I hesitate to speculate on what the framework of potential financial services arrangement would be. I think that, yeah, I should probably leave it there.
Okay, in the middle here, and then Tim at the front left.
Hello, Brian Swint from Bloomberg News. Governor Carney, the MPC's forecasts are based on the average of a range of outcomes for Brexit, and yet you've discussed some other parts of the range in your remarks. I was wondering how much stock we should put in these particular forecasts on the outlook for the economy and for interest rates, and how much relatively, we should be paying attention to what you say the bank, how the bank would respond in different scenarios. I mean, is it still the case that this average is the most likely outcome in your view? And can you give us a feel for how much the MPC is discussing other things in the average?
Okay. So what's the, I think the way we would look at it is, this is the more likely scenario. Something like the average is the more likely scenario. And so it provides an anchor for whether it's financial market participants or businesses or households, to give some sense of how the economy is likely to behave with a deal struck that has a smooth transition to some form of continued access to the European Union. Now, there are better or worse, or there are higher or lower levels of access relative to that average. And so, if one's expectation is that there's going to be greater access, for example, one would expect, all things being equal, higher growth, higher growth both of demand and supply, There would be an adjustment, one would expect, in asset prices in the UK that would be positive, and it would likely have implications for monetary policy as those balanced out. Same thing if it were slightly lower than the average, and potentially change the signs, all things being equal. But we do have to get a sense of how the various the main components go. So it provides. It's both in our judgment, at least at this stage, as much as we can see, and we are deep into the fog of negotiations, so it's difficult to be precise. The more likely outcome, but there's clearly a range of outcomes, particularly around the final, the so-called end-state relationship. And I think we all have to appreciate that as well, that the amount of effort that's being expended on the withdrawal agreement, understandably, and therefore the implementation period, relative to the amount that is being spent on the final relationship. And so one can judge a bit from that in terms of whether we would get a high degree of clarity, obviously, about the withdrawal agreement and the implementation period at the end of the negotiations, and a degree of clarity about the final relationship, but perhaps not total clarity about that over the course of the next few months.
Okay, Tim and then Jason.
Wallace at the Daily Telegraph. Governor, your forecasts show that pay growth seems to be coming back, but also that the household savings ratio is forecast to decline a little bit. Is this a sign that households are spending every extra penny rather than saving a bit more or paying down debt? And
yeah,
should we be worried about that?
Well, I'll let Ben expand on it, but I would say the headline, as I said in my opening comments, is households are resilient. UK households are resilient, and if I could just use one characterization, then I'll pass. And you can see this in the consumer confidence numbers, other surveys. They have a concern, in general, they have concern about the general economic situation, but not about their, or much less so about their personal financial situation and personal outlook. And the consequence of that is that their consumer confidence is about average relative to history, and so spending is growing in line with real incomes. But Ben, on both wages and
no, I have nothing to add really on saving. I would caution not to recognise that the numbers on both saving rate and the household financial numbers get revised very heavily over time. Our forecast is essentially for a flat saving rate, and that spending grows in line with income. And on income, as the governor indicated, and as you suggested as well, it's pretty clear now that wages have accelerated as we expected. We've seen, excluding the volatile bonus bit, the fastest rate of wage growth in almost a decade, and that will help real household incomes.
Okay. Jason next door, and then
thank you. Jason Douglas from the Wall Street Journal. I have a question unrelated to Brexit. I was hoping to ask about central bank independence, if I could. The President of the United States has made
we're in favour of it.
Good, good.
Yeah.
The President of the United States has made pretty clear he would like the Fed to pursue perhaps a different monetary policy. Mario Draghi has come under pressure from some in Europe to do various things, particularly in Italy. And the third example I can think of is in India, where the central bank there is under a bit of pressure from the Modi government. Do these kind of things concern you, and how important is it to preserve central bank independence?
Well, it has been shown that independence in the conduct of monetary policy, and we should be clear about where independence is. It's specific tasks, identifiable tasks. A remit, the best models have a remit or a mandate given from the political authorities with a specific objective. And then there is operational independence, as you know well. But what we're talking about today is what's the right level of interest rates and asset purchases in order to achieve the mandate that has been given, or the remit that has been given to the MPC by ultimately by Parliament through the Chancellor. And one of the things we received with the budget, didn't get big news because it's effectively the same, but was the latest remit letter from the Chancellor, which reinforces that our primary responsibility is to achieve that 2% inflation target, that it's symmetric, that it applies at all times, that we can in exceptional circumstances change the horizon over which we return inflation to target, but only in the event that we're managing a trade-off with growth and activity, and only if that's clearly explained and within credible limits. And that's very, it's very relevant to a situation such as we face here, where, nature of the questions, nature of the inflation report, nature of conversations with businesses in this country are that, yes, there's a fair degree of uncertainty about the outcome of the negotiations. There's a fairly wide range of potential outcomes. Some are much more likely than others, but it's not yet resolved. And what central bank independence and what the structure gives us in that situation is, should give people in the country and businesses and financial markets, is the confidence that the MPC will do what's necessary and has the powers to do what's necessary in order to return inflation to target, whatever happens, whatever course of Brexit we have, whatever shock to the short-term level of inflation is. And it's that which holds longer-term inflation expectations steady and provides a measure of confidence, not just in financial markets, but very importantly to households up and down the country. And if I can say one other thing, that where this is more unique to the UK, but where the Independent Financial Policy Committee, where it comes, central bank, it comes into bear here, is that that committee has the responsibility to ensure, in the case of Brexit, to ensure that our financial system, particularly our major banks, are robust to whatever potential outcome could happen. And that's its responsibility, and it has the powers and the ability, and it is using those powers to do two things. One is to make sure that the banks have the capital and liquidity that they need for the worst case scenario, however unlikely that is, which means that for any other for that situation or any other situation, they're going to be there. And it's also to come straight with people here and across the pond in terms of what we, or across the channel rather, in terms of where we see the biggest risks, so that they can be addressed. So to bring the specific back to the general, I think it is at times like these where you have potentially quite large shocks, could be positive, could be negative, that you see the benefit of carefully specified, publicly accountable, independent, and, as this press conference, I hope, it's a small illustration of this last point, transparent and accountable framework. The value of that comes to the fore, and that holds here, that holds in the United States, and that holds in, throughout the other major economies.
Okay, Yvonne, and then Phil at the back.
Yvonne Esterhazy, German Business Week, Wirtschaftswoche.
Yeah.
Actually, I was wondering, since Brexit is not that far away, if you would like to comment on the preparedness of the banks in the cities. You've mentioned in the past that the bigger institutions seem to be better prepared than the smaller ones. So what is your assessment of the current situation?
In terms of, I think we feel quietly confident in the preparations of the banks, the financial institutions in the United Kingdom. We've been focused on this for the course of the last couple of years. We'll have a chance to talk about this in more detail. Those of you who want to come at the end of the month with the stress tests of the Financial Policy Committee, which will provide more substance to what I'm saying, but our view is that the banks are in a position, they have adequate capital, they have more than adequate liquidity, they have contingency plans. We have contingency plans which buttress those contingency plans of the institutions, and the outstanding issues for the financial sector are largely related to cross-border issues, so issues between the UK and the EU, and we've been, for the last 15 months, we have published a checklist of those issues and the level of preparedness, and some progress has been made. Welcome the comments of the Vice President of the European Commission this week, but we need to move from comments to actual legal certainty, and we look forward to that happening in due course.
Okay, Philip and then Francesca.
Hello, Philip Inman from The Guardian. I was going to try and tease out another answer on this question about why on earth you would raise or interest rates and tighten monetary policy in the event of a no-deal Brexit, but I think we've probably exhausted that subject. I was going to ask Ben and Dave in particular whether they're concerned that the commercial banks, are not passing on your interest rates. You say in your quarterly inflation report that the banks are tightening their margins and they're not really passing on, particularly in mortgage rates. So your efforts are being blunted at the moment in terms of policy.
Dave, do you want to?
I mean, I can certainly highlight what we've seen. I mean, on the deposit rate side, where you never get full pass through, and we're obviously coming out of a really unusual period where normally sight deposits are quite a long way below bank rate, and actually as bank rate came down to zero, sight deposits for a while were slightly above bank rate. As bank rate moves up, it's going to take, we're only expecting partial pass-through, and more generally, we've seen, across both on the deposit side, on the lending side, we've seen through this period of where we put up bank rate twice over the last year, we've seen broadly what we would expect in terms of the degree of pass-through. I mean, as you flagged, there are various pressures on banks on their net interest margins, and we're monitoring that closely. But the degree of pass-through we've seen has been broadly as we expected.
No, on mortgages, I think you're right. I don't think it's necessarily quotes lower pass-through. It's just that at the same time that we happen to have had these two rate increases, there has been more aggressive competition in the mortgage market, and that has depressed some of these margins. I'd only say that monetary policy operates via many more channels than just the rate of interest on new mortgages.
Okay, first of all, Francesca, and then Morgan.
Francesca Washdale from Daily Mail. I also wanted to ask about pass-through, but specifically when it comes to savers. Do you think that you've seen rates being passed on in a positive way to savers? And also, what message would you like to send to savers, particularly in potential uncertainty coming up?
Well, Francesca, a couple things just to supplement what was said. What happened, just broader context, what happened since the crisis is obviously bank rate went from higher levels to as low as it could go, and the relationship between what the banks paid out to savers and bank rate changed. So they used to pay out a little less than bank rate, and they ended up paying out. Actually, they used to pay out about 2 percentage points less than bank rate, and more than a little. And there's a chart in the report which shows that. And as bank rate went down to 0.5% and then to 0.25%, they were paying out more. So to some extent, they're trying to make up some of that ground as bank rate rises. But it's not entirely their choice because we have increasing competition in this market. It's been one of the focuses of this institution. We've authorized just under 40 banks over the course of the last 3 years. There's been some bigger new entrants which are paying substantially higher rates than the traditional entrants, and they're seeing accumulating balances as a consequence. And in general, there's a recognition that there are more options, both not just in the physical branches, but certainly online, for individuals who wish to shop around. So there is first that dynamic, and I'm sure there's some frustrations because it's taking longer, that competition to come through. There's frustrations because of that. But it is part of having a healthier system, greater competition. And then here's the point, which is, I think, crucial to your second bit of your question, which is about if there is concerns of savers because of broader uncertainties, whether it's Brexit or broader uncertainties in the economy. And this is what the Bank of England, one of the key things we've been focused on in the last several years and since the crisis, but increasingly in the last 5 years, is to make sure the core of our system, to make sure, whether they're banks or building societies, that they're resilient. And particularly as we go into this period of uncertainty, and again, the most likely scenario, and what the European Union wants and what the UK wants is some form of agreement. So the most likely scenario is that. Normally when you have a negotiation and everyone wants certain basic things, you end up with them, but we'll see. But in the event that there isn't an agreement, there might be challenges in other sectors, but we've been focused on these issues for the last couple of years. We've been getting the banks ready for the worst case scenarios for the last couple of years. We've been making sure they've been building up capital. We've been making sure they're building up liquidity. We've been making sure the largest ones ring fence the high street banks, the banks you and I and your readers deal with every day, so that they can withstand shocks, whatever comes. And so the people, whether they're going for a mortgage, next week or next year, their bank will be there, and if they're savers, that their money is safe in these institutions.
Okay, Ed, and then Jemana.
Ed Conway again. Just a quick Brexit question. Sorry, another one. Your assumption for Brexit in terms of your forecast is an average of a range of outcomes from very, very smooth to kind of WTO membership or something like it at the end, or WTO terms at the bottom. If very, very close is 1 and WTO is 10, what would you say is Chequers, the white paper that the government has its plan in?
Right. 2 comments. One is our assumption is smooth to whatever situation. So the smooth refers to the transition. So because of course one can have a smooth transition to WTO or a disorderly jump to the WTO. So our assumption when we use WTO is a smooth transition to WTO. And on your scale, obviously we're at 5, right? Or we're right in the middle. Chequers is better than 5. We'll give you precise. It's lower than 5 if I'm following your thing. I won't do it precise. I'm not totally dodging the question. I'm just slightly dodging the question, but but full transparency. The thing is about Chequers is it's government policy. It's a proposal as part of a negotiation, and because it's a proposal, in part because it's a proposal, there's a range. There's certain things about which Chequers is very specific, and others about which it's more open-ended and more subject to negotiation. So, and those components could have important implications for the economic outcome. They're subject to negotiation, and it wouldn't be prudent of me to sit here and say, well, I know that Chequers means exactly this in terms of, for example, access for financial services, the question that Phil Aldrich asked earlier, because it doesn't absolutely specify which components of financial services, how that access would be there. It talks in terms, but doesn't give specifics. And that's the answers to all those questions could be material to where it falls on your spectrum, but more importantly, the implications for the economic outlook.
Okay. Move one along.
Another question. This time I want to ask you about exogenous risks to GDP. In paragraph 6 of the minutes, you talk about euro area GDP growth slowing down, and you said that for Q3 it came in 0.3 percentage points weaker than your expectations. But then there's also lines saying bank staff judge that quarterly growth would recover somewhat in the fourth quarter. So my question to you is, how much of your Q4 GDP forecast is contingent on European economy recovering as well? And if momentum doesn't pick up, does that pose downside risk, especially in an environment of emerging market volatility, trade tensions, et cetera, other exogenous risks?
Yeah, I think I'll let Ben expand on the euro area, but just we have a slowing in Q4 in our forecast for the UK, and a slowing to below potential in Q4. Now, I've got an opportunity to reemphasize something I said in my opening remarks, and the committee noted in the minutes, which is that we do expect some short-term volatility in the data, and a lot of that is domestically oriented, and certainly in the reported data. So anytime you have potentially substantial swings in the level of investment, again, making the precise estimate of that and how that maps into the actual data could come there. And particularly because our predisposition is to look through that because of the unique circumstances the economy is operating in here. With that kind of bottom line, if I may put it that way, context, so we see some slowing, we expect some volatility, we'll expect to look through, obviously take great interest in how the euro area performs in the fourth quarter, but
no, I mean, in general, we, as an open economy, we are extremely influenced by what goes on, and obviously in our trading partners, and most influenced by the biggest trading partners who are in Europe. I think at initial glance, we suspect there may be some temporary factors behind the particularly low number relative to recent figures, that is, for Eurozone growth in the third quarter. So we don't expect that to be sustained. But the Eurozone does look as though it's growing more slowly than it did last year, and coming back down to trend, which is the same shape our whole global forecast has, and that has some bearing on forecast for UK output growth, although next to the Brexit questions, I'd say they're relatively small.
Phil and Joel, yes, probably the last two we've got time for, I think.
Okay, Phil Aldrich at The Times. Just going back to this idea that interest rates may have to rise in a recession, potentially, depending on the supply shock. I just wanted to just calibrate how realistic this is for the supply side of the economy for inflation to rise. The supply side of the economy would have to collapse deep into negative territory. It's around 1.5% is what you say potential growth is at the moment. So we're looking at a big fall in supply it would have to be more so than the fall in demand for you guys to raise rates. Is this realistic? How realistic is this idea?
Well, first, and I'll pass to Ben because I can tell he wants to answer this, but I can tell. You don't have to have negative, you don't have to have falling supply. You have supply growth less than demand growth. So in other words, excess demand continues to build. I think you have to take into account as well, we would have to take into account where the exchange rate moves, which of course is making a judgment about relative future incomes. And in my opening remarks, I again referenced, as I have been doing for the course of the last couple of years, the upward pressure on inflation because of the past depreciation of sterling. Okay, this economy has large and persistent exchange rate pass-through. And just before I pass to Ben, I would, the committee would reemphasize two things. One, monetary policy can go in either direction in the event of no deal, no transition. So it's not automatic, and we're not saying that it's definitely one direction or the other. But also that, the economy's at full capacity right now. Inflation's above target. And, it is a different situation to actually start to get the impact on supply, actual as opposed to perspective, than to be speculating about it. And I said in my opening comments, this is rare. Doesn't happen. You can look for examples. You can go back to the 70s. You know, we've got New Zealand in the 70s. You can make a story around the oil shock in the early 70s. But you're hard-pressed to find other examples of a large negative supply shock in a major advanced economy, certainly a major advanced economy, let alone advanced economy. And there has not been one during the inflation targeting era. Ben?
Yeah, no, I mean, I haven't much to add to that. I'd first of all say, you know, we said nothing about recession one way or the other, so, and indeed, but not us, okay, so we don't know how far supply would have to fall. Second, I'd reiterate two of the Governor's points. One about this is not just about supply and demand, it's about the exchange rate. And if the exchange rate falls, as we saw after 2016, that can have significant effects on inflation for a number of years, and certainly at horizons at which monetary policy should have to take them into account. And third, on the rareness again, I don't think we've drawn any of these parallels, but people have talked about interruptions to energy production in the 1970s. That had material effects on output, but it certainly wasn't a disinflationary event. And it wasn't something you'd normally expect to meet by lowering interest rates. And finally, I'd say, with reference to supply generally, you know, people now recognize clearly that the slow growth we've had in many parts of the developed world since the crisis is a function of low productivity growth. And perhaps I could invert the point by saying this is not something that central banks could cure. And I think people have grasped that. It's not to do with, you know, an absence of easier monetary policy that we've had weak productivity growth. And there are disturbances to these growth rates. And the point we make in this box is that in certain extremely rare instances, and this may be one of them, those disturbances can be quite fast. And so we do have to sort of set, and we're certainly not saying interest rates will go up. That's absolutely not. We're just saying we can't really know in advance.
Okay, last one, just John.
Yes, to go back to access to the EU post-Brexit. You were quoted in the FT, Governor, I think, as saying that a Chequers-type deal would enable the UK to recover 3/4 of the growth that it had lost since the referendum. Was that comment correctly attributed to you? It was in the briefing that you gave to Cabinet, I think, in September.
Well, first off, with respect to Cabinet, I mean, those are confidential discussions, as you know, so I can't comment on those. I'd refer back in terms of Chequers to my answer a moment ago. It would be better than the average. But exactly, I don't want to be drawn on the how precisely, which is what you're trying to do. And then maybe just to close, is that you know, a number of you know, it's understandable people have in their heads the financial crisis and the aftermath of the financial crisis and the series of measures that central banks did in that regard, both for the financial system and also to support demand. And in some respects, central banks were center stage at that time. But in the unlikely event that we have this supply effect, as just to reiterate what Ben just said, is there's not really anything we can do about supply. And to go back to my comment a moment ago about the financial sector, we're pretty much have completed what we're going to do for the financial sector. I mean, again, this is really more of a conversation when the FPC is in front of you in a month's time to draw that out, and we'll continue to work on that. So there are things we will do, and we'll continue to focus on achieving our remit. But we're not center stage. I mean, we're more of a sideshow in that environment, which is still, to close where I started, is still the less likely scenario. It's not what the negotiating parties are trying to achieve. It's not what they intend to achieve. The more likely scenario is that there is some form of agreement. And when you look at our forecast, the MPC's forecast, it provides an anchor for what that could look like. Of course, the final agreement, whatever form it takes, won't be exactly like the forecast, which means when you combine both the fiscal and that, Brexit developments means that, you know, we'll have some work to do to update that forecast once there's greater clarity, and set a course to keep inflation on track to hit its target. Thank you.
Thank you very much, everyone.